program of your life tonight. It's called The Cancer of Inflation, How We Can Heal Ourselves. Today is June 14th, and this is coming to you from Christian Financial Concepts. Our guest speaker tonight is the one, the only, the incredible Tom Barrett. Tom, we're excited about what you have to say tonight.
Well, I'm glad you sound excited.
Well, the Bible says, be transformed by the renewing of your mind. And when you translate renewing, and you're the pastor, correct me if I'm wrong, but renewing means to change your mind. And I know that many people in society have had their minds kind of twisted, and what these programs are about is renewing our minds or changing our minds to see things as they are.
Yes. We need to start, looking at things differently. I've done a webinar where I talk about risk, for instance, and I talk about the fact that we need to look at risk differently because we've been taught certain ways of viewing it. And it's the same thing with the economy. We've been taught that, for instance, the typical government line is that it's bad for you to be in debt, but it's okay for the government to be in debt. Well, what's good for the goose is good for the gander.
Yeah, exactly.
Okay. Well, hopefully everyone is signing in because I would like to go ahead and get started. We have a lot to cover tonight.
I can see people signing in, folks, and if you hadn't, please click on the question panel, and in the bottom space below, please do sign in, and that allows us to communicate with you.
All right. Well, let's jump right into it, Greg. What you're seeing there on the screen is your dollars being flushed down the drain. That's what inflation does to us. Inflation just takes the value of the dollar and decreases it dramatically, and that's what we're seeing in this country. These are some of the headlines we've seen over the last few years. President says the economy, the worst is the Great Depression. Hyperinflation is coming. Dark days ahead. Unemployment hits a 30-year high. Economic experts, gloomy news. The dangerous dollar. Inflation in our future. Other headlines. Still more headlines. Rate of home foreclosures hits a new record. 4-year growth in job ends. Dow off 200. More layoffs in the mortgage industry. So, is hyperinflation coming to a country near you? A rhetorical question. What's the truth? Are these headlines right? Are we heading down the road to hyperinflation? Or is everyone overreacting to normal economic cycles? Or could the truth be somewhere in between? Is everyone being hysterical?
And Tom, can I throw another question in there?
Sure.
We have seen signs, quote, signs of recovery. Are those headlines, did they come amongst the signs of recovery, or is that before, or where did they come from?
Aha. And are the signs true signs?
Yes.
Lots of questions. Okay. To get to the truth about inflation, first we have to understand what inflation is. Now, it would be great if we had hours and we could really get into this in the context of what's happening in inflation worldwide, but we're going to have to concentrate on our own country tonight. So we even have to leave Canada out tonight. Sorry, Greg. But we're going to limit it mainly to the United States, but put what we talk about in a world context, if you will. So before we can even define inflation, we have to define how inflation has defined us. Now, you've heard me say before that for the first 157 years of our republic, we had essentially no inflation. Now, that's not true in a micro sense. We had periods of inflation and we had periods of deflation. But when I say essentially no inflation, I mean that if you average it out, basically we were in 1933 pretty much where we were in 1776. The average wage was $20 in 1933, and it was $20 in 1776. Gold was at $20 an ounce in 1933. It was about $20. I think it was $19.70 some cents in 1776. So essentially, no inflation if you average it all together over the first 2/3 of our existence. But since 1933, inflation has grown hugely, and it's such a normal part of our lives that we accept it as a normal thing, but it's not normal, nor is it acceptable. It's not something that we should just accept. Now here's something I've been looking for over a year, and I finally found it. Here's a chart of inflation from 1776 to the present time. It's actually from 1774. I got a little bit more than I asked for. So over here is, let me just pull up my little highlighter thing. I finally learned how to use this thing. Right over in here is 1776, right? And as you can see, we sort of flirted around ups and downs. But here's the $1 mark. So everything is keyed on the dollar, 1933. And so in 1776, the dollar was worth a little more. It's worth about $1.40 of what the 1933 dollar was. So it had dropped somewhat. So you might say it was a little deflationary. But look at what happened from 1933 on. Just a steady decline all the way through to present time. Now, what could have caused that?
Well, guess what? Can I say what Michael has said already? Or should we wait? Oh, by the way, folks, when you're online, we love your passion. I love what Michael said a little bit earlier. He says, in capital letters, do you really want to get rid of inflation? Get rid of the Federal Reserve, which is as much as federal as Federal Express.
Thank you, Michael.
And then he does identify what happened in 1933, Tom.
He does.
Which was,
dun-da-da.
Maybe we should wait for you.
Well, it's fine. He says in 1933, FDR ended the gold standard.
Yeah.
So here's what happened from 1913 to 2006 with the dollar. Now, why 1913? I want you to see graphically the dollar from 1913, and then there's 1933, because 1913 is when the Federal Reserve System started.
Yeah. And
there was a dramatic drop there. Then there was a little recovery, and then from 1933, practically straight down to today. And today's dollar is worth about 5 cents, 4 to 5 cents of what the 1933 dollar was. So a dramatic, terrible drop. So if you ask the average person on the street, what is inflation? I know, isn't it cute? What is inflation? They say, well, inflation is rising prices. No. That's like saying that eggs cause chickens. Rising prices are a result of inflation, but they're just one of the results of inflation.
Yeah.
In the simplest terms, inflation is the devaluation of a nation's currency.
Yeah.
But if you really want to get down to the truth of the matter, it's the expansion of the nation's money supply. If you're a farmer and you grow grain or corn, whatever, if you have a bumper crop of corn one year, you're happy at first because you say, wow, I've got more corn to sell. But then when you get to the market, you find out, lo and behold, everybody had a bumper crop because the rain fell on the just and the unjust. Yes. And so everybody's got lots and lots of corn there, and Economics 101 kicked in. Supply and demand, there's more supply, therefore demand is lowered and prices dropped. Okay, so more corn, lower prices. Well, it's the same thing with dollars. All right, if you pump more dollars into the money supply, then they become less, and the dollars become worth less and less until they become worthless. Now, this wasn't the case when we were on the gold standard, because you couldn't just keep pumping dollars into the money supply, because every dollar had to be backed by precious metals.
Right.
But once we disconnected the dollar from precious metals, then it became just another commodity like corn. Okay? So, to me, the most honest way of defining inflation is to say that it's a tax, because it was created by the government. Only the government has the power to cause inflation. It's a hidden tax. They don't call it a tax. It's hidden away, but without doubt, it's a tax. And it's the most destructive tax the government levies on us, because it destroys our productivity. Once upon a time, here in the United States of America, the land of the free and the home of the brave, we had real money. Today, we have monopoly money. That even looks fake, doesn't it?
Mm-hmm.
Look at them side by side. The bill on the top, that's a gold certificate. Most of you have never seen one except in pictures. Most of us have never seen one in person. Now, look at the one below. When you compare them side by side, to me, it's just as obvious as can be that one's a fake and one's real. I'm not going to spend a lot of time on this, but I do want to mention that at the top here it says, this certifies that there have been deposited in the Treasury of the United States of America $20 in gold coin payable to the bearer on demand. Some of you have seen U.S. $20 gold coins. Yes, you can actually go take that certificate in, and it was a legal note. It was a certificate. It was a demand note. And you could turn it in and get gold coins for them. 1 ounce gold coins. The same gold coins that are worth around $1,220, $1,225 today. Okay? Now, down here, you don't see a gold certificate, do you? You see a Federal Reserve note, a Federal Reserve seal. This is not the seal of the United States. This is the seal of a private corporation. Sorry to disappoint anyone, but the Federal Reserve is not federal. This is a collection of private banks that control the monetary policy and the economy of the United States of America.
And beyond. But that's another seminar.
They have a lot of control over the world economy, but the Fed is not federal. I would highly recommend to you The Creature from Jekyll Island by Gilbert Griffin, another book, In the Fed by Ron Paul, and an article I wrote called The Non-Federal Fed that will explain to you. I don't have time to go into this tonight, but it's very important material. It's very important that you understand that the Federal Reserve, every word in that name, the Federal Reserve System, is a lie. It's not federal. It's private banks that run it. There are no reserves, and it's not a system. It's a central bank. Why didn't they just call it the Federal Reserve Central Bank? Why weren't they honest about it? The reason they didn't call it what it really is very simple. The Founding Fathers didn't want a central bank. They've suffered under central banks in Europe. That's why you don't find a provision for it in the Constitution. That's why originally the Supreme Court struck it down as unconstitutional. And that's why, I bet a lot of people don't know this, how many people know that we had a central bank prior to the Federal Reserve System? Just pop it up on the screen if you knew that we had a central bank before we had the Federal Reserve System. Anybody? Well, how about, does anybody know that we had 2 central banks prior to the Federal Reserve System? Yes. The first was called the First Bank of the United States, and the second, not very imaginatively, was called the Second Bank of the United States. I kid you not. They both failed miserably. Neither one of them lasted more than about 20 years. They both brought great harm and hardship to the country, and nobody wanted to see a return engagement. So that's why they had to sneak it in. And that's why the creature from Jekyll Island describes secret meetings by
Yes.
turncoat bankers and European industrialists and very cloak and dagger stuff, where they snuck in the Federal Reserve System, they twisted the arms of congressmen and so on, and they got this thing passed. Very, very sneaky.
Was it late in December too, wasn't it? Just before Christmas when half the people were gone? Was that accurate?
I'm not sure about that, but you're probably right.
I think so. Yeah.
Now, this is what could be in our future. A lot of people feel like there's no way that we can avoid hyperinflation in this country. I'm hopeful that we can, but the worse things get, the less likely it seems that we can escape this fate. In 1919, Germany was doing exactly what we're doing today, trying to print its way out of its debt problem. At that point, the exchange rate was 4 Deutschmarks, that was their main currency, to 1 US dollar. 4 years later, the exchange rate was 4.2 trillion Deutschmarks to the dollar. Talk about hyperinflation. Did you say crikey?
I said incredible, but crikey applies as well. Crikey, Tom.
Here is a 500 million mark note, right? Up to that point, the biggest note they'd had was a 100 mark note, which would be about the equivalent of $400, right? By 1923, they were printing $500 million mark notes, or 500 million mark notes, and then they started printing 5 billion mark notes. That's what this 5 Milliarden mark note is. But interestingly, by the time they got this back from the printer, in just a matter of weeks, inflation had gotten so bad that they turned them around and sent them back to the printer. There wasn't time to make up new engravings and print new notes, so they overprinted the 5 Milliarden notes with 100 Milliarden, or 100 billion mark notes. This is in a matter of 4 years. There are pictures of street sweepers sweeping up not trillion, but million mark notes in the streets because nobody wanted to pick them up. People were using them for wallpaper and toilet paper. Now people say, oh, well, that can't happen today. We have modern economies. This is not like in the olden days in Germany. Well, let me tell you, folks, 10% of modern nations, this is within the last 40 years, 10% of modern nations have experienced hyperinflation. So it's not just the old style economies. Argentina is a modern nation. They started having inflation problems back as far as 1940, but it wasn't too bad. They kept it down to an average around 10.6% a year. But from 1949 on, their inflation grew until 1980 to 89, it reached an average of 750% a year. That's bad. In 89, their inflation got as high as 4,900%, and in March of that year, it hit 20,000%. They were having to pay their employees, not twice a month like a lot of companies do here in the States, twice a day. Their money became worthless that quickly, so that they would pay them at lunchtime. The people would run out. Instead of going to lunch, they'd buy whatever was available on the shelves, shoe polish or whatever they could find, because by the end of the day, they'd be able to barter with that and get more for it than their money. And they'd pay them again at the end of the day, and they'd spend that on their way home.
Shoe polish, now, Tom?
Whatever they could find.
How about a okay? Yeah.
Floss, whatever. Now, most of us have heard that Bank of America was bailed out by the U.S. government recently, right? We have a very short memory in this country. Most people don't realize that 20 years ago, the U.S. also bailed out Bank of America. At that time, the financial press was referring to Bank of America as bankrupt of America. And the reason for that was because they were heavily overextended in Latin America, particularly in Argentina, and they were about to go under along with the nation of Argentina. Argentina was about to take Bank of America under. So the U.S. government bailed out Argentina by way of bailing out Bank of America, but they laid out some strict rules. They said that in return for us bailing you out, you have to no longer print any money that's not backed. Every peso had to be backed either by gold or by U.S. dollars. And that was just one of the things. But after 50 years of the highest inflation in Latin America, this policy, along with some other austerity measures, reduced their inflation to 0% within 5 years.
Well, Tom, that's tremendous. That was recommended by the USA government?
The U.S. government said this is what you have to do. Not recommended. They required it. They also...
Well, that's great advice then. It worked.
They also required them to reduce bureaucracy, to reduce taxes, and to privatize public businesses. And they also had to cut government spending. They dropped their government spending from 35.6% of GDP to 27% in 5 years. And within 2 years, they reduced their deficit to 0. And every single peso was backed. Now, here's the interesting part. All that's good stuff, right? Here's the interesting part.
Fantastic.
Today, we're doing exactly the opposite of what we forced Argentina to do to fix their economic disaster. We're doing to ourselves exactly what Argentina did to themselves to cause themselves to get into that problem in the first place. And we know better. It's insane. Now, currently, we have a nation in the world that's going through worse hyperinflation than we've ever seen. Zimbabwe. 4 years ago, their dollar was very close to ours. $1.25 Zimbabwe equaled $1 US. Over that 4 years, they've managed to achieve the unenviable record of having the highest inflation rate in world history, 231 million%. I've seen pictures of a man going to the grocery store with literally an armload of high denomination notes. I mean, a bushel of huge notes.
They'd have to get paid every hour.
Yes. Here's one picture that was in the news. A cost of one egg, $36 million. You know, 3 eggs were $100 billion. And remember, their dollar 4 years prior to this picture was the same as ours, or almost exactly the same as ours. They printed the largest banknote in the history of the world, $100 trillion. So, Germany, was an old-style economy. Argentina, well, you know, they're South American. Zimbabwe, yeah, they're a third world country. We are kidding ourselves if we're so arrogant as to say that we couldn't be the next one. This nation has the greatest debt burden of any nation that's ever existed on the face of the planet. No nation has ever owed more money in terms of pure dollars than we do. Now, in terms of debt per citizen, we're not as bad. Right now, each of us on this call tonight only owes about $44,000. Okay? By the time we get up to where the CBO says we're going to be in the next few years, the average American family owe $250,000. But hey, you know, most of us can handle that, right? All joking aside, this is not a laughing matter. Okay. I did some numbers. I found an inflation calculator using government inflation rates. Now, please understand, this is using what the government says inflation was. I don't totally trust this. I'll be honest with you. I think that it's much higher than this, and I can explain why if we have time in the Q&A period. But what I did is I went in and put in periods of every 30 years because I didn't have time to do it every year or 5 years or whatever. The first period I put in was the 20-year period from 1913 to 1933 because I wanted to make sure we cut that little slice of time out. So if you purchased an item for $1 in 1913, then bought that same item in 1933, it would cost you $1.31. So your rate of change was 31.3%, and up at the top, that works out to an average increase of about 1.5% a year. That's basically nothing in the inflation world. Okay, now from 1933, when we went off the gold standard in 1963, over that 30 years, we had an increase of 135%. So divide that by the 30 years, and you get 4.5% a year. Again, not real bad. That's about what the government says we're experiencing right now. That's what we've averaged for the last 4 years. In reality, it's more like 8 to 12%, but again, we can talk about that later. But here's where it gets really scary. From 1963 to 1993, the average inflation, or the total inflation rate of change was 372%. So you divide that by 30 years, you get 12.4% a year that they admit to. And most any economist will tell you that whatever the government admits to as far as the inflation rate, you can double that and you're probably going to be pretty close to accurate. Now, from 1993 to 2023, which would be the next 30-year period, nobody knows. A lot of people feel like what's going to happen to us is what happened in Germany, that it's going to come upon us suddenly, that when and if hyperinflation hits, there will be no warning. I read an interview with a gentleman who was there in Germany when it happened. He's now a professor here in this country. And in his interview, he said, like lightning gets struck. We had no warning.
Yeah.
Suddenly, no one would take our paper money.
Yeah. Yeah.
And if you didn't have gold, you were in big trouble. Okay. Is 18% of our total economy too much to pay just in interest? How would you like to be paying 18% of your entire income in interest alone? Maybe some of you are doing that, but it's not healthy. This is how you get this. We're paying $450 billion annual interest on the national debt. This is as of 6 months ago. It's probably much worse now. That's based on $2.7 trillion annual tax revenues. So with our interest rates very low, that means that we're paying 18% of our total revenues just to service the national debt. That's no principal reduction whatsoever. So what do you think is going to happen when rates rise? We're in a very low interest rate environment. We can't stay here forever. When interest rates go up, what do you think is going to happen? And what about when the principal goes up? We can't service more than 18%. We can't afford that. If we pay any more than that, then we're going to have to stop paying for our airplanes, paying our service people, paying Social Security. I mean, there is no more room for interest. So something's got to give. We're going to have to default somewhere. Go ahead, Greg. I'm sorry.
Well, I was just going to say on the call last week, Chris and I pulled up the debt calculator, and we were just astounded at how fast those numbers were clicking through. I mean, it's just unbelievable. And again, we just invite people to Google debt clock, and you'll see for yourself. You can't imagine it, how quickly the debt is growing, and it just verifies what Tom says.
Yeah, actually, I pulled that up at the beginning. We usually do a conference call every Tuesday night at 6 o'clock about gold, and we did it tonight because of some scheduling problems. So I did 2 conference calls today, and at the beginning of the call, I actually put that USDebtClock.org site up live. And remember when you did your PowerPoints, I told you I thought that the unfunded liabilities of the United States were greater than what you had them down. I thought they were over 100 trillion. Well, guess what they were tonight? I took the time to look it up. They're over $109 trillion. Wow. So you add the national debt to the unfunded liabilities, which are liabilities of the government that they're obligated to pay for, Medicare, Social Security, and so on, that are mandated, but there's no budget for them. And it works out to $122 trillion. Now, this joker on the screen one point sarcastically said that the U.S. government has a technology called a printing press that allows it to produce as many U.S. dollars as it wishes at essentially no cost. He thought he was being funny, you know. This is before he became chairman of the Federal Reserve System.
Yeah. Mm-hmm.
What he was basically saying to the American people is, your money is worthless. You know, all we have to do, we want to make more of it, is we just print it. So your money is not worth anything. Well, now he's a little more serious. He said just this week, it was actually on the 9th, last Wednesday, the federal budget appears to be on an unsustainable path. That was his testimony before Congress. He's getting a little more serious now.
That is a foreboding statement. What happened to the markets when he said that, Tom?
They did not like it very much. Now, our deficit is going nuts. This was the projected deficit. It actually turned out to be much bigger than this. It was way in excess of $1.9 trillion, the biggest deficit ever in the history of the United States. The largest prior to that was the 2008 deficit, which was almost $500 billion. And his deficit, Obama's first deficit, was 5 times larger, 5 times bigger than the biggest deficit ever. The CBO, when it was calculated, that didn't include any of the costs of the health care bill that's just been passed or the energy bill. So these are obviously going to add billions of dollars to the deficit and trillions to the debt. Mm-hmm. There's a difference, of course, between the deficit, which is how much each year we're behind on the amount of money that we're spending as opposed to the amount that we take in, and the national debt, which is that amount of the deficit that gets added to the total debt every year. Yeah. The debt itself is mind-boggling. A year ago, and this is actually a mistake, the CBO stated the national debt would skyrocket to $20 trillion. It's actually $22 trillion they said it would go to in the next decade. So that's 9 years from now. Conservative economists said that was not true. It was going to double in the next 5 years. At that point, a year ago, it was about $11 trillion. When Obama took office, the debt was about $10.4 trillion. Within 6 months, it was up to $11 trillion, and they said it was going to double within a decade. Now, just a year and a half into his administration, it's at $13 trillion. So over $1.5 trillion added just in a year and a half. The conservative economists, who I trust a lot more, say that it's not going to double the next decade, it's going to triple. So that would put it at $33 trillion 9 years from now. So it's just absolutely mind-boggling. And if we're barely covering the interest on an $11, $12 trillion debt, how in the world are we going to cover it on a $33 trillion debt? The White House budget director, a guy named Peter Orszag, said the United States is on an unsustainable fiscal course. Now, kind of similar wording, although he was the one that said it first back in April. Bernanke was parroting him just this last week. I'm not sure exactly what's going on, because these are not words that you expect to hear from the most liberal administration that we've seen since FDR. I mean, this is the kind of thing you expect to hear from Glenn Beck or John McCain, not from the White House budget director. But if they're warning us that we're in serious trouble, then you better take notice. You know, it's like the old saying, if somebody calls you, one person calls you a jackass, you can ignore him. But if 5 people call you a jackass, you better go out and buy yourself a saddle. Mm-hmm. Mm-hmm. So we need to protect ourselves. The government knows that we have an impending disaster, but there's no political will to prevent it. When Bernanke made this statement that we have an unsustainable debt, the next statement he made right after that was, but you understand that we had to increase the debt because of the pain of the recession. So he's talking out of both sides of his mouth. At the same time as he was saying that the debt is wrong, it's bad, it's unsustainable, he was excusing it in almost the same sentence. So there's obviously no political will to prevent the disaster, because the only way to prevent it is to cut the debt. So we can't count on the government to protect us. We're going to have to protect ourselves. Okay.
Michael makes an interesting comment, Tom, and maybe you can talk about this later. He says, at this time, the U.S. government is too big to fail as the world's reserve currency. If we fail, the world fails. Maybe you can comment on that later.
It's an interesting point.
Yeah.
But, you know, we've made this statement about certain banks that certain people in government have relationships with, and we said they're too big to fail, and we bailed them out. But when we make a statement like someone is too big to fail, that means that somebody has to bail them out. Who is going to bail out the United States?
Yeah.
At some point, we have to either do what other countries are starting to do. Right now, our Congress is asking the Federal Reserve Chairman, why aren't we doing what Germany and England are doing? They're starting to make some painful cutbacks in spending because they know that they have to, or they're going to default on their debt. And while Bernanke was praising them for doing that, the congressmen, the Republicans, of course, were asking Bernanke, well, why are you praising them and yet not recommending to the U.S. government to do the same thing? Because our deficit to GDP and our debt to GDP ratios are about the same as those of England and Germany. So you're saying it's good for them to do it, but you're not recommending it to our government. He says, well, the United States is special, you know. Well, the law of gravity applies to everybody.
Yeah.
And financial laws apply to everybody. Michael does quote something that our former Fed chairman, Alan Greenspan, said. He doesn't attribute it, but I happen to know the quote. He says, in the absence of the gold standard, there's no way to protect savings from confiscation through inflation. There is no safe store of value. Gold stands as a protector of property rights. Oh, yes, he does attribute. I'm sorry. These remarks were from Alan Greenspan before he went to work for the Federal Reserve. So he had brains before he went, and then he got brainwashed, obviously.
That's right.
But it's very interesting what he says here. In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. Remember what I said earlier, that inflation was a function of government. Who else can confiscate your savings through inflation? No one except the government. No one can cause inflation, and no one else can benefit from inflation except the government. Okay, let me move on because I have quite a few more slides. Who owns us? Who owns the U.S.? Well, of the total foreign ownership of United States Treasury securities, by far the biggest owner is Communist China. They call it mainland China, but I like to call a spade and not an agricultural implement. This is the commies, Red China, our biggest enemy in the world, who still refers to us as the enemy in their inner circles, owns 24% of our debt. And here's something interesting. Secretly, China had been building up its stockpiles of gold for years, since 2003. It was only revealed this last year, just a little over a year ago, that they've been increasing their stockpiles of gold, and that they're Now it's out. They admitted that the finance minister admitted that they're going to increase their stockpiles by another 500%. Now, let me ask you a question. Where are they getting the money to buy the gold? They're selling dollars. That's the biggest holding they have is dollars. So this is a confirmation of years of speculation that it had been buying gold. They've been doing it secretly because they don't want to see the dollar crash while they're still holding tons of dollars.
Yeah.
But they're sandbagging us, baby. Okay, so are we going to see yet another foreclosure? I mean, we already see foreign countries owning landmarks in the United States. The Sears Tower, national monuments are owned. I mean, wouldn't it be a kick if China foreclosed on the White House? I mean, this is a little tongue-in-cheek, obviously, but this is a scary thought. I mean, the Chinese and other governments own huge portions of our national economy. And
I didn't know Japan had 20% too. That's significant.
Yeah, the second biggest owner. At least they're friendly to us. China is still trying to figure out ways to make intercontinental ballistic missiles that'll hit us. All Japan wants to do is sell us DVD players.
Mm-hmm.
Proverbs 22:7, the debtor is slave to the lender. And nobody can tell me that our debt position with China has not affected our relationship with China. Just in the last few years, several things that have happened. They have shipped to us baby formula with, I believe it's called melamine in it, that has made babies sick, and I believe some have died. We did nothing. Toys with lead paint in them, which has been illegal in this country for decades. Drywall that has made people sick and made sick homes. I told people on one webinar, I was offered a home in Palm Beach, which is close to where I live, for $180,000, a home that was built and was going to sell for over $1.5 million, but they found out the drywall they put in was from China, and it ruined the house. They had to strip off all the drywall off these 15, 20-foot high ceilings, off all the walls, because the drywall had, I think it was formaldehyde in it, something like that, that was causing corrosion of all the wires and all the piping. And so it made the house almost worthless. Now, 20 years ago, if any of those things had happened, we would have retaliated big time against China. But we can't, because the debtor is slave to the lender. It'd be like, Greg, if you were behind on your rent, if you were renting your house instead of, I know you own your house, but if you were a renter and you were behind 6 months on your rent, and the landlord came over to your house and he was drunk and he ran over your rose bushes and kicked your dog, you wouldn't be able to do too much about it because you're in debt. And that's pretty much the position we're in. I mean, it's a shameful position for the United States to be in, to have a bully country like China in a position of power over us like this. So, the typical American family of four, their share of the national debt, once it gets to where the CBO says it's going to be, $250,000. And I've spoken on this in the World Money shows and audiences of hundreds and thousands of people. And I always ask, how many people here are planning on paying off their share of the national debt anytime soon? And strangely enough, nobody ever raises their hand. Very few people could afford to, and those that could afford to aren't about to donate $250,000 to the U.S. government because they know it's just going to go down the tubes. So, what can you do with this information? I said at the beginning that this is not going to be all doom and gloom, that there would be information on how we can deal with the situation. Well, the obvious answer, since everything stemmed from going off the gold standard, would be to put the nation back in the gold standard. That would be the ideal. But that's not going to happen. for two reasons. Number one, as I said, the political will is not there. The politicians just do not, they're not going to stand up and say we have to do the hard thing and put our country back on a solid fiscal course. The other thing is, even if they did have the guts to do it, we don't have enough gold yet. Somebody asked on the thing here, where's all the gold that used to be at Fort Knox? Nobody knows. But it's for darn sure they don't let anybody take tours of Fort Knox anymore like they used to. So all those pictures you see of Fort Knox, they're historical pictures. Nobody's taking any pictures these days. But it's estimated that there's maybe enough gold in Fort Knox left to cover 2 or 3% of the money that we have in circulation. And that's probably going to go down on a regular basis. It might be down to 1.5 to 2% by now, for all we know. So we couldn't go back on the gold standard if the government was willing to. So what's the answer? Well, we can put our families on the gold standard. For almost 35 years now, I've, like a lot of other financial advisors and financial planners, have advised people to put at least 10% of their, what we call the non-residence assets. In other words, your net worth minus your primary residence into gold. Today, again, along with an awful lot of other people who understand what's going on, we've revised that to say a minimum, not just 10%, but a minimum of 10%, more, 20, 30% or more if you can, of all your assets, not just of your non-residence assets. Why? Because the danger is much worse. We need to take stronger measures because our savings could literally become worthless. So if you put your family on the gold standard, which basically means if you have at least 10% of your net worth in gold, and if we do have hyperinflation, then that 10% could easily become worth as much or more than your entire current net worth. Because if we have hyperinflation, the dollar will probably go down to 8 to 10 cents on the current dollar. I mean, the dollar is down 96% roughly from what it was in 1933, 77 years ago. But can you imagine going down another 90%? That's what would happen in hyperinflation. So if you had gold and just regular gold, I'm not talking about the what I call investment grade gold, which will actually not only protect you against inflation but also increase in value. But if you just have gold bullion, just basic industrial grade gold, if you will, that will at least keep you even with inflation. That would protect you against the ravages of inflation.
So if you had a home worth $100,000 and you had a portfolio worth $100,000, that's $200,000. So that you should have $20,000 of that at least in gold.
Yes, yes, sir. So a little common sense for the Word of God. Proverbs 21:20. Be sensible and store up precious treasures. Don't waste them like a fool. Most people spend as much as they make, and one day it'll catch up to them. The people that are wise will save money and put it away. So that's my advice. Some resources that are available to you, and you can email to this email address, rarecoins@att.net, and get any of these articles. Some of them are also available on this website. In Debt We Trust, that's written by Greg Halloway, The History of Money, the 10-10-10 Financial Survival Plan. That's actually a formula for how to invest in gold and in silver, how to use a combination of various different kinds of precious metals assets. The article I mentioned earlier, the non-federal Fed, and an article specifically about investing in gold called Golden Art. It's actually a PDF file, and it's a scholarly monograph. So you can write to rarecoins@att.net and get copies of any of those. And of course, There's a number of different webinars, as most of you know, that are on this call. You've attended a lot of them. But if you write to webinars@bellsouth.net, I can send you links to prior webinars. And if you're interested in the prior webinars that are held on Tuesday nights at 6 o'clock, or if you'd like to be on the list for those webinars, then you can write to rarecoins@att.net and ask to be put on that list. And I'll just mention one other thing really quickly here. During Germany's hyperinflation, at the height of it, you could have bought an entire city block of downtown Berlin, prime commercial property, with 25 ounces gold. Talk about gold being king. Okay, yeah. That would be like buying a city block of Manhattan today for roughly $30,000 at today's gold prices. Okay? Guys, you can't buy a parking space for 1 year in Manhattan for $30,000 today. But if we have hyperinflation, you see the kind of bargains you'll be able to get. You'll be able to buy about anything you want and name your price if you have gold, because gold will be king. So with that, I will put this back up on the screen so that you can write down the email addresses, or if you'd like, you can go to conservativetruth.org, and most of these, except for the monograph, the articles are there, and you can find them on the website in the archives. And we'll take some questions. Greg, you want to just shoot the questions to me, or?
Yes. Well, just regarding what you said, what you just said about buying the property in Berlin, Tom, KJ asks, he makes a humorous comment. Was that after it was bombed? I don't think so. Do you know what year that was by chance?
That was 1923.
1923. Okay.
That was when it went to 1.2 trillion marks to the dollar. That was at the height of their hyperinflation.
Right. He also makes a comment and asks a question. Tom, I read recently in the mainstream news that India has greatly reduced their normal demand for gold. Have you heard anything about this?
I've heard that it had pulled back some, and I think, from what I understand, that has to do more, not so much with their desire for gold, but more with just economic issues in the country. India is the biggest consumer of gold in the world. China, not far behind them. By the way, guess where the biggest coin show is, the biggest gold show is every year in the world? It's Beijing. It used to be Orlando, Florida. They considered it a really big, successful event if they had 12,000 people at the Orlando show. Now in Beijing, they'll have a couple of 100,000 people at their big coin show every year. China has become a big gold bug country, and it's smart. Not only is China increasing their gold reserves as a nation by 500% over the next few years, but they're also encouraging their citizens to own gold. In this country, we discourage people from owning gold. We actually made it illegal for our citizens to own gold from 1933 to 1972. Illegal, right? And here, China, I hate to say it, but they're smarter than us. They're encouraging their citizens to own it because effectively, when the citizens own it, the nation owns it, right? So here, the nation's buying gold and the citizens individually buying gold, so that's that much more gold in the country. And that just makes the country that much stronger. So while we're spending like crazy, the average savings, that was another little tidbit from the debtclock.org, the average savings in the United States per family, guess what? $1,000.
Oh my goodness.
Is that pitiful?
That is just only God. KJ makes another comment. He says, I spoke to a friend in Iran, and he said that gold is people's first choice for investment.
Yeah.
Gold. They think of gold first, before real estate, before anything on the markets. It's gold.
Well, make sure you listen to next week's webinar, because this week is laying the foundation for next week's webinar, which is going to be called The Case for Gold. Actually, tonight's webinar and next week's webinar were one webinar, and I just had so much material gathered up that I realized I had to chop it in two. And so I made it into two webinars, and it worked out just fine. I ended up with about an hour of material for tonight. But next week, I'm going to be talking about the world demand for gold. In Germany, for instance, I'll give you a little preview, and now in other European countries as well, in airports, they have machines, vending machines for gold. And you can go and buy 10th ounce, quarter ounce, half ounce, 1 ounce gold pieces from vending machines. And there's such a demand for gold that people are paying a 30% premium over spot price. I personally would never pay 30% over spot. I would shop around and, never pay more than 10%, but they're paying 30% over spot just for convenience. They're walking to the airport, getting on their plane, and say, oh, gold, cool. And they go stuff euros in these machines, and they're buying gold, and they're emptying the machines out.
Wow.
Germany has lost their currency twice in the last 100 years. So they're very sensitive to the fact that paper money is worthless. There's never been a paper currency in the history of the world that has lasted, that has succeeded. So again, we don't take a very big view of things. We only look at our little short experience. 200 some years of experience is very, very short in the grander scheme of things. But currencies typically don't last. France, my friend Greg Holloway shared an experience where he was in a coin shop in Paris.
Tom, we can't hear you anymore.
I'm sorry.
Oh, there you are.
Okay. Greg was sharing an experience where he was in a coin dealer's shop, and he saw like $250,000 worth of gold coins being bought in just a matter of a few hours. And when there was a little lull, Greg asked the guy, he says, why is everybody so excited about gold here in Paris? And he says, it's like this all over France, not just Paris. He said, we've seen our currency fail 4 times in this country, and people just don't trust paper money. And Greg said, well, in America, people are not so concerned about things like that. And the Frenchman, in typical Gallic, blunt fashion, he said, well, then Americans are stupid,
The Americans, they are stupid anyways, eh?
Yeah. So,
Tom, Mash asked a question, by saving gold, do you mean pure gold, or does jewelry count as well?
Well, number one, Mash, when I was a kid, I worked in the jewelry business, and I can tell you that most of the gold that you buy in jewelry form is only a relatively small percentage gold. Like your typical jewelry is 10 karat. That's 10/24 gold. 14 karat is 14/24 gold, and so on. So that's not a very good way to saving gold. There's a lot of alloys. I mean, a big part of it is other metals. But the other problem with jewelry is that if you run into hard times and you want to use that as money, you're going to have a hard time, because weights and measures. How do you know exactly how much gold you've got? Is your scale accurate? That type of thing. And then, how do you know for sure what carat it is? When I was in the jewelry business, we got in jewelry that was marked 14 karat, but if you knew what you were doing, you could look at it, you could tell it was really 10 karat. But if people don't know, they're going to be leery of it. So the best way to buy gold is either in bars or ingots, or preferably coins, because the coins have stamped right on them and you want coins that have been issued by a sovereign government too. That's important because people are going to trust that more. And where a sovereign government has stamped it that it's this particular denomination, and it's well known what the fineness of that particular coin is and the weight of that particular coin is. So
Tom,
that's the safest way.
I'm seeing more entities springing up. I was in a mall in the United States on the weekend, and it said, "Bring in your jewelry. We'll buy it. We'll bring in your gold jewelry. We'll buy it from you." So we know what's going on there. They're taking that and melting it off.
Message, obviously.
Yeah. So, well, Tom, we're just passing over the hour here. The cancer of inflation and how we can heal ourselves. I guess the best way we can heal ourselves is to protect ourselves, and that is with the unfailable gold. And so
yes,
we're excited about hearing what you have to say next week. And folks, as I always say, this information is good for ourselves and our families as individuals, but do pass it on to your other friends and family so they can make their own informed decision. Tom, I get the feeling that time is running short.
Yeah, when you see the things you're talking about, these stores springing up everywhere, people trying to buy gold, if you think about it, just to set up one of those operations, it costs several $1 million. So people know that gold is going to go up much higher. I'm not going to tell you how high gold is going to go, but personally, I'm buying as much gold as I can and holding it. By the way, Mesh says that most of what his family has is 22 karat. That's about as good as it gets. You know, 24 karat is pure gold, which is very, very soft, and you can't really make jewelry out of 24 karat gold. So 22 karat is about as close as you can get. So that's good stuff. And Michael makes one statement that in '71, Richard Nixon ended the gold standard. Actually, the gold standard ended, Michael, with FDR. What happened with Richard Nixon, you make the correct statement, he suspended the convertibility of the dollar into gold. But what he ended was something called the Bretton Woods Agreement, which is what I call the gold standard light. Okay, under the true gold standard, the Gold Standard Act, the dollar had to be backed dollar for dollar with gold. And the Bretton Woods Agreement, there was a partial backing. It was a formula, let's say, 1 to 5. So it really wasn't a backed dollar. It was sort of a token backing, and it was fake. Okay, it wasn't a real thing, and so eventually it had to go. So that's what Nixon actually suspended, so they talk about him suspending the gold standard, but in reality, it had been gone a long time before that. And that's why inflation had ravaged the United States so much prior to Richard Nixon, but it did accelerate after that. Okay, well, we're about out of time.
That's all. That's all Watergate under the bridge, anyways.
Here's something.
Sorry, folks. It's getting late.
It is. Well, Greg, I appreciate you, buddy. And we thank everyone for being on the call tonight.
Thank you, everybody. Good night, and God bless.